Welcome, market participants, to another Three Things in Credit. I'm Van Hester, Chief Market Strategist for KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. So, stocks are on a tear driven by expectations for strong earnings, prospects for a reopening of the Strait of Hormuz, and strong technicals, notably expectations for $1 trillion in buybacks. Bloomberg's monthly tally of street strategists is out, albeit before Friday's Strait announcement, and only 3 of 22 surveyed took their year-end estimate for the S&P 500 down from the prior month, and only 2 are forecasting the year-end level to be below where we are today, and those estimates are just 1.4% lower. The median estimate for the year-end close is 7,500, 10% above the 2025 close. The median EPS estimate at $3.10 a share is up only fractionally from the estimate at year-end 2025, but still a healthy 14% above the year-ago level. Complacency or more U.S. exceptionalism? You decide. This week, our three things are: 1. Growth shock versus inflation shock. What's the biggest risk? 2. Big bank credit color. Real-time read on credit from the largest lenders. And 3. IMF sours. Its latest forecasts recognize a laundry list of risks. All right, let's dig a bit deeper. Growth shock versus inflation shock. So 6 weeks into the latest geopolitical shock, where are we? Well, stocks in the U.S. have bounced back from an initial sell-off of 9% to hit all-time highs once again. The VIX has retreated back into benign territory. Credit spreads had clawed back half of their widening, and the risk premium over treasuries remains well inside long-term averages. New issues continue to be enthusiastically received, and risk market moves are consistent with what we're seeing in rates markets, where yields across all G10 markets are higher since the outbreak of the Middle East war. So, in the great debate coming out of what war will bring, a growth shock versus a rate shock, i.e., inflation pressure, the risk of higher inflation is winning. That presumably brings a hawkish tilt to central bank reaction functions. And sure enough, markets are pricing in 2 hikes in the Eurozone and Japan and 1 hike in the UK. The US is seen as being on hold, with some, including ourselves, forecasting 1 cut in the second half. So, what's implied by the recent market moves? Well, for starters, less risk of a material growth shock. There was plenty of uncertainty around this topic, mostly centered on the possibility that oil prices would spike higher and remain there for an extended period of time. Markets have come to dismiss the worst scenario outcomes here based on 2 considerations. One, the spike in oil needs to be far greater than we think to materially impact growth. And 2, a belief among investors that a workable solution is possible over the near term. On point 1, markets quickly came to understand that the risk of $100 oil just isn't what it once was due to significant increase in energy efficiency and the effects of inflation, which, when adjusting accordingly, makes the worry threshold today not $100 a barrel, but more like $190. With markets believing risk of macroeconomic growth shock has diminished, investor focus has turned back to microeconomic growth with Q1 earnings season underway. Expectations here are buoyant, with growth in the S&P 500 expected to come in at 12% despite the headline-driven environment. Much of that earnings growth is expected to come from the technology sector, which in spots, especially megacaps, is trading less like growth and more like value. This is not to say that distribution tails have not widened. The left tail, the riskier end, has. But the midpoint of this distribution, the base case for risk assets, has improved with better visibility into and greater confidence surrounding the ultimate resolution of events in the Middle East. All right, on to our second thing: big bank credit color. So investors remain on cockroach watch. Not so much signs that we have had a turn in the credit cycle, we haven't. More for signs of lax credit underwriting over the past several years that produces concern that those deficiencies are more widespread, that the credit blowups we've seen over the past 6 months are, to mix metaphors, the tip of the iceberg. Investors remain hyper-focused on private credit as a potential source of cockroaches, given perceived opacity and flexibility around the lender's valuation process, despite the fact that most of the high-profile blowups we've seen were originated in the syndicated bank loan and public ABS debt markets, not private credit. In any event, loan quality trends coming out of the largest banks is always a good place to look for an update on credit. First, the lead. Overall, loan quality remains quite well behaved among the largest banks, reflecting the relatively strong economy and the relatively upbeat forward look, even in the face of elevated geopolitical uncertainty and the spike in energy prices. Loan loss reserve builds range from a negative 1%, i.e., a loan loss reserve release, at Bank America and Wells Fargo, to a 3% build at JP Morgan Chase and a 5% build at Citigroup. Non-performing loan ratios at all four banks were flat to down in the quarter at levels that are historically low. Credit card loss rates, the best proxy for consumer loan quality, are down year over year at all four banks. At JPM, management commented, notwithstanding the recent volatility in market and gas prices, consumers and small businesses remain resilient. Specifically with regard to the consumer, there really is not anything new or interesting to say this quarter, said management. We've looked at it through every angle: early roll rates, delinquency rates, cash buffers, spend, discretionary spend, non discretionary spend. It all looks consistent with prior trends and fundamentally healthy. On its loan loss reserving methodology, management commented that we start with a model based approach based on economic forecasts. In light of global developments, we did sort of have a very conscious debate about this as a company. Like, should we add downside skew to the weights this quarter, given everything that's going on? And our conclusion was that the existing kind of conservative bias in the reserve was sufficient. Management added that in their reserving model, we did not change the weights this quarter, and we actually lowered the weighted average unemployment rate assumption from 5.8% to 5.6%. At B of A, net charge-offs, card delinquencies, reservable criticized assets, and non-performing loans all declined versus the first quarter of 2025, reflecting continued benign credit results. Management added that while risks are out there, the ongoing conflicts in the Middle East, including implications for the energy market, inflation, and growth, the macro backdrop remains constructive. The consumer continues to spend, and corporate customer activity is stronger than a year ago. Over at Wells Fargo, credit performance has remained strong and in line with expectations. Management noted that while the U.S. labor market continues to cool in an orderly but uneven fashion, there are few signs of systemic stress. While the U.S. consumer remains resilient in the aggregate, it is increasingly bifurcated beneath the surface. Management expects continued volatility driven by geopolitical headlines and outcomes, as well as the unfolding impact of higher commodity prices. All right, on to our third thing: IMF sours. Downside risks dominate the outlook. So says the IMF out this week with its World Economic Outlook titled ominously, Global Economy in the Shadow of War. The agency goes on to list what threatens growth: a longer or broader conflict in the Middle East, worsening geopolitical fragmentation, a reassessment of expectations surrounding artificial intelligence driven productivity, and renewed trade tensions. Any or all of these shocks, coupled with elevated public debt and eroding institutional credibility, could significantly weaken growth and destabilize financial markets, so says the fund. As if that wasn't enough, while scaling up of defense spending prompted by a rise in geopolitical tensions could boost economic activity in the short term, it could also bring about inflationary pressures, weaken fiscal and external sustainability, and risk crowding out social spending, which could in turn ignite discontent and social unrest. Now, that's a half empty glass if there ever was one. By the numbers, the IMF is forecasting 2026 global growth of 3.1%. That's 0.2 of a point lower than its previous forecast made back in January. Regionally, the fund is calling for 2026 growth of 2.3% in the U.S., a tick lower compared to 3 months ago, 1.1% in the Eurozone versus 1.3%, and 4.4% in China. That's down from 4.5% in the previous estimate. The fund acknowledges in its economic forecast tailwinds from technology-related capex, accommodative financial conditions, and fiscal and monetary support, along with reduced uncertainty related to trade policy. It also acknowledges the challenge of forecasting in the face of war. That said, it reduced 2026 estimated global growth from 3.4% to 3.1% due to the conflict in the Middle East. Under adverse scenarios with larger and more persistent increases in energy prices, the fund takes global growth down to between 2 and 2.5% in 2026, while inflation moves up to somewhere between 5.4 and 6%. And for context, global growth in 2000 to 2019 averaged 3.7%. Apart from the effects of war, the fund warns that larger fiscal deficits and rising public debt amid already eroded buffers could place upward pressure on long term interest rates and tighten financial conditions. Related, the fund still considers financial stability risks remain elevated, reflecting high debt levels and greater rollover risks in core sovereign bond markets, a more price sensitive investor base, a buildup of leverage across non bank financial intermediaries and derivative products, rising interconnectedness between banks and non banks, vulnerabilities in private credit, and growing market concentration risk in AI related sectors. We wouldn't quibble with any of these observations, but what's missing here is the likelihood that any one of these factors could, over the near term, materially and sustainably derail economic growth and reprice assets. In other words, these risks are either tail risks or a long term buildup in imbalances. So we're not surprised the fund, given its mission, focuses their attention accordingly on these tail and longer term risks. That said, we do not believe the fund's observations call into question where developed world credit risk is priced today. So there you have it. Three things in credit. One, growth shock versus inflation shock. Inflation is more worrisome at this point. Two, big bank credit color. For bankable credit, i.e., higher quality, the current quality and outlook are strong. And three, IMF sours. Lots of risks, but nothing that implies risk today is mispriced. As always, thanks for joining. Don't forget to check in on kbra.com for our ratings reports and our latest research. We'll see you next week.